What is LLC? LLC is limited liability company. And why is it different than self-proprietor? Oftentimes when we have a trade or something that we're good at, we really focus on what we do and we start the business, but we don't really have the business planning for it. Some of us, they can go and apply for an EIN number, which is a social security as a self-proprietor, or some just do it. Basically, all the income comes through their personal income, which is a big no-no in the business world. Why is it important to differentiate between a self-proprietor and an LLC? Number one, as a business owner, your goal is to what? To grow your business, to scale up. When we first start, oftentimes we don't think about that. We don't really concentrate on that in the beginning, but as you continue to grow, before you know it, you're making the big bucks. How to leverage your taxes when you make big money. It's not a secret that when you make more money, you're going to be paying more taxes. But one of the things is, before you even get to that, is how to limit your liability. Shield yourself from your personal income. Oftentimes, any profession that we have, there's always a risk that we're going to get sued. There's always a risk of things happening in the business where it can come back to you as your personal income. One of the things we always suggest to our clients is to open an LLC, limited liability company. You're still a subject of the 15.2 self-employment tax, just as you are as a self-proprietor. However, it limits the liability and it shields your business and your personal income from your business, separates it. First, we create the LLC for you. We do everything from A to Z, and it's done right. It's done by the book. You take those documents. Usually takes about 4 or 5 days, about a week turnaround or less. You get the EIN number. You get the minute order. You get all these documents in there. You open your bank account with it, a business bank account, and everything flows through your business bank account. And this way, you differentiate between your personal and your company. One of the main things, also a goal here, is to do the right accounting, because everything starts with accounting. Accounting is the foundation for how you're going to do your taxes. You cannot, as a self-proprietor, commingle both of them. It becomes very difficult. Oftentimes, they go to their tax person at the end of the year and they just give a bunch of statements and then let them figure it out. Well, guess what? They might have 2 or 3 hours to figure it out, but they're not going to give you accurate numbers. You are actually cheating yourself because you're paying more taxes this way. You're not separating the expenses of the business. You think you are. There are more expenses that you can properly document, but that starts with accounting. And you cannot do that as a self-proprietor. The goal is to have a limited liability company, LLC. That's a proper way to do this. Open a business bank account, and everything flows, all the business-related material flows through the business bank account. And your personal gives you personal. Now, you're still subject to 15.2%, but guess what? As an LLC, you can still file for that as an S corporation in order to eliminate the 15.2%. Right, Tanya?
So S Corp, the way it works, the more money you make, you want to go on S Corp. LLC is great, like Andy said, but as an S Corp, it's a pass-through entity. What is that? Your S Corp will not pay taxes, like the federal taxes or California taxes. Everything is gonna come to you. Let's say the gross revenues, you make $1 million. After expenses, let's say it's $200,000 is left in the company. So that's gonna be a K1. So it's a distribution to the shareholder of the company. So it's going to be an income to the owner of that S Corp. But what it does is not only it shields you from any creditors like the LLC or potential legal issues that may come up in the future or in the process, but also allows you as a business owner, the IRS says you must pay yourself a reasonable compensation. Remember, on the LLC, you didn't have to have payroll. But on the S Corp, you're subject to payroll. So you, as the owner of the company, including your employees, if you have employees, you have to have a payroll, no matter what. So that way it will allow you to have the S treatment of your corporation. What I like about the S Corp is you can do a lot of great things in the S Corp. Tax planning, amazing opportunities there to reduce the taxes legally. So an S Corp, pretty much, it's one of the best entities. It depends what kind of business and the growth of the business, but in my eyes, my suggestion, depending on we see what kind of business you have, the amount of revenues you make on a yearly basis, S Corp is a great entity for a business owner that's starting and growing and growing. You can pretty much reduce thousands of dollars or even hundreds of thousands of dollars through your S entity. But like I said earlier, you have to have a payroll. That's a big difference.
Now, oftentimes tell us, what is a payroll? It's very important. Again, people, what they do, they do elect the S corporation. They even open an S corporation, or they get an LLC and then they file as an S Corp, but they don't do the payroll. Well, you're really cheating the system. The IRS will catch it. In order to avoid a 15.2%, that's what they do. Well, the proper way to do that, you have to give yourself a payroll. Payroll is anywhere between 30 to 40% depending on your gross income, what you make. It's a reasonable compensation, but you do have to pay yourself those taxes in order to qualify for that. Otherwise, you still be paying the additional 15.2% self-employment tax. So the way to do this is we structure it correctly. We build it block by block. So this way, when it comes down to the tax planning, we have all these different strategies that we can utilize, because a lot of these strategies cannot be utilized if you do not have those proper steps. And if you step a step, what you're doing is you're risking getting audited. In fact, I can guarantee you will get an audit, because when they submit this and it goes to the state of California, the Franchise Tax Board, or even to the IRS, these are all computerized systems. One of the items they're going to look at, if you file as an S corporation but you don't have a payroll, they're going to look at your payroll deduction, and there's no payroll deduction, that's a red flag. Then it's going to come back, it's going to trigger an audit. You don't want to do that. You want to show that. Oftentimes they say, well, I don't pay your payroll taxes. Well, again, it's reasonable compensation, and we can come up with a proper number that's going to go in there and it's going to satisfy the IRS and the Franchise Tax Board, so you don't have to pay the 15.2% self-employment tax. All of us want to save on taxes. But in order to do that, again, as I stated before, everything is block by block. We do this, and then we can introduce different variety of different things, tax codes of how do you reduce those taxes at the end of the year, the right way, the proper way. That's where the tax planning kicks in. Oftentimes people go to their tax preparer that they've had for many years, and they ask them, I want to pay less taxes. Well, they come back to them, and not all of them, but some, give them more expenses than they deserve. You have to understand, every industry, certain deduction that per the industry, median type of deduction, and the IRS knows that based on your industry, based on the income, the gross receipts you're bringing. But oftentimes people inflate those numbers. You might get away with it 1 or 2 years, but I guarantee you it will trigger an audit eventually, and the IRS can go back 3 years. 3 years in the past and give you an audit. You don't want to do that again. You want to do it right, because what they do is they pack on interest and penalty on top of that. But if you do it correctly from the first time and allow us to show you how to legally give you these deductions, because deductions have limitations. But oftentimes people just want to inflate those numbers so they can pay less taxes. What the furthest you inflate those, the simplest thing the IRS or the Franchise Tax Board is going to do is they're going to send you a letter. They will never call you. They will never email you. They send you a letter saying, well, on such and such, on such year, you disclose these type of deductions. One of the main ones we see is, oftentimes deductions for charity, for instance. People tend to inflate those, which is okay. Now, the IRS says you can technically claim up to 50% of your income for charity. But you better be ready to produce receipts. All it takes is one phone call to Herbert Financial Group. It's a free complimentary phone call. The first meeting is on us. That meeting, when you come in for the interview, is on us. We sit there. You have a team of experts. You have an accountant, an enrolled agent, a CPA, a financial advisor. 4 to 5, 6 different people sitting in, giving you at least 1 hour minimum or more, free complimentary, discussing your business and tell you how we can actually effectively reduce your taxes the right way, the legal way, the IRS way. And then we go to business. We'll go to work for you to make sure that you pay less taxes, so you don't have to deal with the IRS or the Franchise Tax Board. Grow your business. Either you work on the business or in the business, and do it right, and you pay less taxes than what you paid the year prior. Come to us. You won't be disappointed.